Wall Street just launched over 770 new products this year. Already, over 70 of these products have been shut down completely. And the people that are buying these products don't even know how they actually work most of the time. Now, in this video, I'm going to give you 3 ways in which you can recognize whether ETF products like these are financial instruments or actually a financial trap. Now, I'm an anesthesiologist by training, and I spend my days monitoring patients' vital signs, which can switch at a second's notice. But when I evaluate the ETF market today, I see a patient whose vital signs are rapidly deteriorating. And instead of formulating a diagnosis and treating appropriately, Wall Street seems completely content to treat this patient with more and more stimulant drugs. Now let's take a look at how these stimulant drugs are affecting our patient. So in this first chart, over 770 ETFs have been launched. That is an unprecedented number, is setting all-time records, and is actually up over 55% year over year. And even more impressive than the sheer number is what's actually housed in these products. Now, over 50% of these that have been released house what's called derivatives. And if you don't know what a derivative is, I just want you to think of it simply as a financial contract, sometimes called a future contract or a swap, that makes a directional bet on whether the underlying asset goes up or down. Now, ETFs themselves are exchange traded funds, and they are a basket of assets that really just follow an index. That's all they do. And for the purposes of this video, leveraged ETFs are the same thing, but they try to 2, 3, sometimes even 4x the return, not over the course of a year, but over the course of a day. And I want you to remember this because it's going to be very important later on in the discussion. But even more astounding is over 1,000 leveraged ETFs have been filed with the regulators this year alone. This is not a normal supply and demand picture. This is the supply chain running way faster ahead than the regulators have the ability to determine whether or not they're safe. Something else that never gets talked about right now is the 73 ETFs that have been fully liquidated and left for dead. Now, in medicine, this would look like a patient that is hyperactive, but is crashing at the same time. And that is something that we do not ignore the contradiction. We investigate it. Now, a part of our investigation highlights something that's extremely important. Remember when I talked about the leveraged ETF and how it tries to 2, 3, 4x the return, not over the course of a year, but over the course of a day. It does this, it rebalances every single day. And just to highlight how important this is and how detrimental it can be to your capital, I want to go through a concrete example. So say you put $100 in a 2x leveraged ETF fund. The underlying index goes up 10%, your return is 20%. So you start with $100, now you have $120. So far, so good. Then the next day, the underlying index goes down by 10%. So up 10%, down 10%. It's pretty much even. But your return or your loss now is minus 10% of that new higher principal, which was $120. So 20% of that 120 is now 96. So although the ETF, the underlying index, is actually even, your net leverage position is minus 4%. Now consider this not just on a daily basis, but compounded day after day, week after week, month after month, year after year. I think you can see how the returns can start to be catastrophic. And this difference between what you think your portfolio is worth and what that math is actually dictating, that's known as volatility decay. And it is an absolute capital killer if you don't know what you're doing. Now, I want you to think of a medication with a half-life 24 hours. If you take it for a single day, no problems at all. But if you take it day after day, week after week, year after year, those side effects don't just add up. They compound in ways that are completely erratic, they can't be forecasted, and can cause catastrophic damage to your portfolio. So why in 2026 are these ETFs suddenly exploding? Well, there are 3 factors that I want to bring to your attention that I think are causing it. So first is the assets under management. Almost $150 billion of these long leveraged ETFs are under asset management today. Whereas the inverse ETFs, they only have about $12 billion under management and are decreasing. The market signal here is extremely clear. They're not betting on any more downside risk, and their bets are all to one side on the market continuing in this bull market. Now, second, and this is what's most concerning of all, retail access. Almost 25% of these long leveraged ETF products are housed in the accounts of these retail investors. These aren't institutional grade investors that have an intricate understanding of the daily reset mechanism or utilize them for short-term positioning and tactical trading. They have no idea, for the most part, what they're doing. This is like me prescribing a medication to a patient without going through the side effect profile or the dosing schedule. And this is essentially what's happening here. You're taking an extremely volatile and dangerous derivative product and you're packaging it into a safe ETF wrapper and then putting it into an index fund. And then on top of that, what's even more insidious is that these ETF products are easily accessible on Robinhood, Interactive Brokers, E-Trade, you name it. You can just click a button and you can get access without any safeguards or any warning at all. And third is the issuer is making money on assets under management. So in this bull market, money floods in. The more they issue, the more they file, the more they launch, the more they turn over, the more money they're going to make. And remember, over 73 of these products have been closed already this year. Now let's draw our attention to South Korea because this is the biggest warning sign we have right now. Back in June, the Kospi, the South Korean index fund, fell by almost 40%. And in that process, almost $40 billion worth of South Korean retail investors' capital has been eradicated, including almost 350,000 retail accounts that were margin called and closed completely. Now, after the dust settled, of course, these regulators came out and they said that they're going to ban any new ETF listings and they're going to increase margin requirements. But as it usually happens, they left retail investors holding the bag, and $40 billion of retail capital has been lost forever. So what exactly do you do with this information? If you're an independent investor and you're not actively trading on a professional basis, you might hold them in a retirement account. You might be tempted by the triple leveraged semiconductor ETF that's up 80% year on year. But here are the numbers that I would check, the vital signs, before touching any of these leveraged ETFs. So the first vital sign is the leverage ratio itself. 2, 3, 4 times higher leverage means faster decay. Remember back to our example, and that was on 2x. Imagine on 4x leverage. And if that goes against you a couple of days in a row, the losses could compound and be exponential and blow up your portfolio. And just like a medication, understand the side effect profile and how you're going to actually dose it in your portfolio. So vital sign number 2 is the expense ratio. Leveraged ETFs can carry expense ratio up to 0.75 to 1.5%, which is much, much higher than these plain vanilla ETFs that just simply track the index. And remember, it's not just that these expense ratios are much higher, it's the volatility decay that occurs. So again, understand what you're buying, understand the risks involved. And vital sign number 3, average daily volume. If the volume is thin and what's called the bid to ask spread widens, which is an easy way to see if there's liquidity or not, then you're paying a third hidden cost you enter or exit. And for a product designed for short-term holding, illiquidity is a deal breaker. Less than 1 million shares a day, stay away from it. And guys, let me be completely transparent with you. I work full-time and I don't have time to be monitoring these leverage products all day or staring at charts. And I'm guessing you don't either. But that's what this channel, Medicine to Macro, is all about. The more you understand just the fundamentals and the different derivatives and the hyper financialization that's occurring and what the dangers are, then you're going to be more inclined to make sound investing decisions. And remember that movement is medicine. The more you move, the more you ask questions, and the more curious you are, then that will bleed over into more sound investing decisions in the markets and in life itself. Thank you for tuning in to Medicine to Macro. If you found this diagnostic framework useful, please consider subscribing to the channel, and I'll see you on the next video. Cheers.